My name's Dave Dubeau, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Welcome back, gang. We got another great guest zooming in from beautiful Charleston, South Carolina. We got Charles Seaman. He is a very experienced syndicator, and he knows a lot, especially when it comes to underwriting deals. In fact, he's kind of the go-to guy. Many people have learned that whole process from, and he's a fellow podcast host and overall a very accomplished real estate entrepreneur. So welcome to the show, Charles.
Hey, thanks for having me. It's a pleasure to be here.
All right, so give us a little snapshot. We're in May 2025. What do you focus on when it comes to real estate investing? What does the portfolio kind of currently look like? Where are we at this point?
So right now for me, it's been primarily a multifamily. The portfolio I have is all multifamily through syndication deals that I'm involved in.
Yeah.
Going forward, I would still keep it some multifamily. I'd probably mix in some other commercial assets and maybe even some single family, which isn't something I seriously considered in the past. But diversification is a good thing. I think there's a lot of uncertainty in the market, a lot of uncertainty in the economy, but I think that uncertainty also is going to create opportunity.
All right, very good. So what has your buy box been up until now, Charles? Like what kind of projects do you work on, and what is your involvement? Are you the kind of the primary syndicator? Are you a co-GP on these projects? How does real estate look for you?
Yeah, so for me personally, I've always been pretty hands-on. Part of it is I just tend to be a control freak, so I have something to do with it. So my role with the deals that I've been in has been finding the deals, structuring them, and really overseeing the asset management once we're in them. So pretty much everything except the capital raising. I've always been more of a supporting player in that versus a lead player there. But everything else I'm a lead player on. And when I first started, it was 50 unit and up apartment complexes. Now it's 100 units and up. And, but there's still some good opportunities in those smaller deals. So maybe time to start looking at some of those again.
Got it. So do you go in with a group? Are you kind of a co-GP on these projects, the larger ones typically, or how does that work?
Yes, co-GP, yep.
Yeah, very cool. And when it comes to smaller deals, now that you start to look at that, maybe for folks that aren't super familiar, tell us why you think that's a good asset class to be looking at these days.
So the reason I think the larger multifamily deals still have a lot of competition, which is expected. They always will. But I think that even though values have dropped 25 to 30% since the peak of the market in 2022, a lot of these deals still don't make sense to me. I think they're overpriced still.
Still?
Yeah, I think they need to have a substantially larger correction. Nobody wants to hear that.
Yeah.
The smaller and medium-sized deals, I think some of them could potentially make sense. Similar to single family, you might be able to find one that's owned by a mom and pop owner, maybe a long-term owner that's, got rents far below where they could be. So there could be unrealized potential that could allow you to really get a nice discount and be able to make some money in it. And I think same thing with single family, where those opportunities exist. You'll see a lot of those opportunities in the smaller and medium-sized multi-properties. So may not be a bad time to look at those.
So really you're looking for properties that you can get into at under market value, typically that have challenges as far as being under market rent for the kind of property, and that's the value add that you want to bring in. Is that correct?
Right.
Yeah. Just kind of bring them up to snuff.
Yep.
Cool. Any particular markets that excite you more than others these days, Charles?
Well, the past couple of years, I've really been focused on a lot of the Sun Belt region. Most of those markets still excite me, but I do think the challenge there is that a lot of them are still in the process of resetting. Now, the good news is that a lot of those markets had a tremendous amount of supply delivered in the last 2 years. Many of them have substantially completed those deliveries, so now it's really onto absorption. There's a handful of markets that, still have additional deliveries coming, like Charlotte, like Austin, Texas, handful of others. Just about anywhere in the Carolinas, I think, still has a lot of potential. If I'm looking for cash flow, I'm going to go to the Midwest. I like Columbus, Ohio. I like Indianapolis. I think those are solid cash flow markets that still have a little bit of a pop on the appreciation. If I'm going more appreciation, less cash flow, then I'm focusing in the Sun Belt region.
Got it. So circling back to the whole looking at single family homes after being a multifamily guy for a long time, are you looking to like buy onesie twosie properties, or are you looking to buy portfolios of single family homes?
Great question. So there's actually two things I'm looking at. So one would be buying portfolios. And I think there's opportunities to do that. I think there's a lot,
You got a little scale and leverage there. Yeah.
right.
Yeah. Yeah.
And you know what? There's also opportunity right now because a lot of big home builders need to get rid of homes that they've built and they
Mm.
can't sell them. So a lot of these big home builders financing some of these things 100%.
Wow.
And sometimes they're financing them 100% and cutting the price because they can't sell them. And these are newly built, top-notch, brand new homes. But some of the biggest home builders out there can't sell them. They need to get them off their books. So I think there's an opportunity for that. The second thing I'm looking at, although maybe a little bit dangerous with where the market is potentially partnering with an experienced single family person to do some flips.
Mm.
And I like the idea of, being able to generate more cash on a regular basis. With anything in real estate, it's usually slow build. With the flip, it gives you the ability to make some money faster. Doing a one-off doesn't really intrigue me too much, but figuring out how to scale it and how to make it a duplicatable model where we can go out there and do multiple flips at a time and start to ramp up the revenue, that to me becomes a lot more attractive.
That makes a lot of sense. Yeah, I've interviewed a number of people that are in that space, and it's definitely doable. It's been done. It's being done. So if other people have figured it out, it's definitely a viable option there.
Yeah,
Interesting, Charles. I'm fascinated about your observation there with the buying these nice brand new single family homes directly from the developers up to 100% financing. Doesn't get much better than that.
right.
Yeah, and now are they typically charging fairly reasonable rates for the financing, or are they trying to make their money on
They,
interest
they,
rates
they
and
are generally charging reasonable rates for what's out there today. If
yeah.
people are looking for the interest rates they were seeing in 2020 and 2021, they're going to have an unrealistic expectation, but
Mhm.
they'll charge you similar to what a normal lender would charge. And the good thing with a lot of those home builders is they have the financing arms in house, so they can kind of set the terms and the rates on those loans.
So with the goal there, I mean, do you see these kind of properties cash flowing significantly?
No, I see them
No.
cash flowing minimally, but I see them also having less headache, less hassle, and being able to build equity for the long term.
So
I do think they'll cash flow, but I think it'll be a nominal amount of cash flow. So if anybody is looking to retire in those, in week two, they're probably not going to get there.
no, obviously not. Well, that's really interesting. So if you do kind of go down that road and you're buying directly from the builder or the developer, like you thinking buying 10, 15 of these suckers at a time kind of thing, or what would you be
That,
doing?
that
Yeah.
would kind of be my thought.
Yeah.
And with some of the home builders, they're open to even letting more of those go because if they have more to get rid of, they're happy to play ball because for them it's more important to clear them off their books than it is to keep them on there for a long period of time.
Yeah. Interesting. Well, there's always opportunities, aren't there?
Yeah.
It's a matter of getting creative. So you're looking at, yeah, you're kind of going the direction that it's counterintuitive, going from multifamily to potentially single family, but again, buying them in batches versus onesie twosies.
Yep.
Yeah.
And what I would also say is I think it's important to pivot with the market.
Yeah.
So I think it's good to have a favorite strategy or two, but I think it's good not to be married to it. You want to be flexible where if the market goes right, you can follow the market.
Yeah.
You keep nimble so that way you're able to adjust and kind of capitalize on what the market gives you.
Sounds good. So, Charles, I know that you're also a fellow podcaster. Tell us a little bit about your show.
Yes, absolutely. So my podcast is on the Master Passive Income network of podcasts, and it's called the Master Passive Income Multifamily Podcast. And it's geared towards multifamily commercial real estate investing. So We have a lot of educational discussion, myself and a co-host, and we also have guests on there periodically. So we enjoy, putting out a weekly episode with that.
Very cool. You've been doing that for a while?
About 7 or 8 months now. It was definitely an adjustment. I've been a guest on many podcasts, but it's different when you're the host for sure. It requires a lot more thinking and planning,
Hmm.
and all the things that you don't think of when you just get the luxury of being a guest on there.
So you mentioned earlier that you're very hands-on when it comes to asset management, finding deals, analyzing deals, managing the property once you've got them. Not so much on the capital raising side of things. Do you do some capital raising, or do you have other partners that do that for you?
So for the most part, I have other partners that do. What I always like to tell people is that I'm really more of a supporting role on the capital raising side.
Hmm.
So the role that I play there is typically when somebody's unable to answer a question, they usually bring the investor to me. So if the investor um, has fairly standard questions, a lot of my partners are able to answer those on their own. But if they have things that are beyond their level of expertise, then they bring it to me, and I usually explain it in a way that makes it understandable for the investors.
That's a huge value that you bring there for sure. All right. So what are your kind of goals and aspirations for the rest of this year, Charles, 2025? Where do you see things going?
Well, my goals and aspirations would be to get involved in more deals, but I think to be very selective. And I think also to not get ahead of the market. I think there will be opportunities, but I think patience is going to be a virtue. That virtue might be tested this year,
Hmm.
but waiting will be key and really just, adjusting with the market. Um, I always say in real estate, there's usually three reasons people fail. You run out of time, you run out of money, or some combination of both. And in my perception, the way you can de-risk a lot of these deals is by having longer hold periods. With the syndication model specifically, it's really designed for that shorter hold period of 3 to 5 years. So you don't get the luxury of allowing the market to correct if something goes against you. Um, but if you're out there and you have a 20 or 30-year timeline, that changes a lot of variables because then all of a sudden deals can make sense even if they didn't make sense at the beginning.
Most definitely. Well, let me ask you about this because you've been in the syndication game for a long time. One of the things that kind of, how can I put this nicely? That irks me a little bit about
Yep.
syndications and multifamily is the churn side of things. And I mean, I get it, but it seems like a lot of syndicators, especially in the go-go days, it was all about get the property, get the acquisition fees, get the management fees, get it flipped as quickly as possible, rinse and repeat, get on there, get on to the next one. And very little thought about just holding on to properties long term, like you just mentioned, and seeing like that long term benefit of holding on to these. Which if you zoom out, I completely get it. You got to keep the lights on. You got to make money. It's tough to convince people to invest for the long term. They're looking for short term gains as well. But what are your kind of thoughts about that long term versus short term?
Great question. So in general, I think the syndication model, the way it is now, is kind of broken.
I agree. Yeah, I that's what I feel.
Yeah. But I think short term is great when the market cooperates with you. It doesn't give you a lot of forgiveness if the market reverses course.
Yeah.
And I think it's probably something that if you're going to be looking at a hold of 3 to 5 years, you really need to be confident on where you are in the cycle. And you need to be confident that you have enough time to execute the plan because one of the challenges, as we record this in 2025, there's a lot of deals that were purchased in 2021 and 2022 at the top of the market.
Yeah.
And a lot of those deals aren't going to have happy endings. Some of them are going to have very bad endings, but those endings will create opportunities. So
Exactly.
I think it's important for both syndicators and investors to be clear on where we are in the cycle and to be disciplined enough to respect where we are in the cycle because that's very challenging. Uh, I think there probably are things in the model that could be tweaked to take away some of that risk, but it would probably take a big adjustment on both the syndicators and the investors to really accept some of the changes and de-risk these deals a bit.
Yeah. Yeah. I agree 100% with you. Got an acquaintance of mine, very successful multifamily investor. That was her whole philosophy was really about buy it and never sell it kind of thing. Now
Yeah,
she did end up selling her portfolio when it made sense, but she went into it and she talked to her investors about, hey, don't invest unless you're willing to have your money in here potentially for 15 to 20 years.
right.
Believe it or not, she got lots of investors happy to do that, and it was really focused on a cash flow play. Um, yeah,
To further your point, uh, there's two things I would say that I'm a big believer in that a lot of people in our industry probably wouldn't be big fans of, but I think they do a lot for risk management. One is the longer term hold. So the most successful investors that I know personally are long term hold people. They they do very well for themselves. They don't own properties with a million partners, and they hold these properties forever.
yeah,
And they do well with them because over time the rents go up, the values go up. You can refinance and pull cash out if you want to. There's a lot of benefits to doing that. And the second thing is, I don't think it's a bad thing to pay down mortgages sometimes. I think having a couple of properties free and clear helps you sleep better when there's a downturn. I
yeah.
know it's not a popular opinion in our industry a lot of times, but some of these successful investors I've seen also do that. And I say, well, if these guys are doing it, they're a lot smarter than I am. There's a reason for that.
No, you're absolutely right, Charles. I agree with you. We're kind of fed this by some high level gurus, a la Robert Kiyosaki, et cetera, that you never want to pay off your mortgage. You want to be as leveraged as possible. But you're right. I mean, um, having those free and clear assets makes a lot of sense. Holding on to stuff long term makes a lot of sense, and anything else is really, in my mind, very speculative.
Yeah, I agree.
Yeah, yeah, no. Well, hey, Charles, this is a fun conversation. I really am excited for you with this new direction you're looking at with the single family homes and working directly with builders and that idea. I hope you do find some good portfolios and take a crack at that. And then maybe in 6 or 12 months, we can have a chat again and see how things are going, or a couple of years and see how that part of your portfolio is going.
Yeah, absolutely. I'd love to do that.
All right, Charles, I'm sure a lot of people are going to say, hey, that guy's a pretty smart guy. I'd like to connect with him. What's the best way for people to do that?
Sure, the best way. So in the show notes, my link tree will be included. It's linktree/Charles_Seaman, Seaman. And that'll have all my relevant social media links as well as my podcast link.
Perfect. And people want to find your podcast on iTunes or something like that. What should they look for again?
MPI Multifamily Podcast, and it's on Apple Podcasts and Spotify.
Awesome, Charles. Thanks for being on the show. It's been a lot of fun.
Dave, thanks for having me.
All right, everybody, take care. We'll see you on the next one. Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.